We've had a very long-standing partnership with the New York Stock Exchange. Dick Grasso's name came up earlier today, and that's as far as at least I can remember the partnership goes, from Dick Grasso to Kathy Kinney, and it has continued. And Stacey has been such a strong supporter of the center's work and everything that we do. Stacey, we are absolutely delighted to have you back again this year.
I'm delighted to be here, and congratulations on 10 years of the center. It's fantastic that for so long you've been providing so much to the industry.
Thank you. As the group already knows, Stacey is the president of the New York Stock Exchange Group, which includes the New York Stock Exchange and a diverse range of equity options exchanges, all wholly owned subsidiaries of the Intercontinental Exchange. Stacey is the 67th president and the first woman to lead the New York Stock Exchange Group in its 227-year history. So, it is just so important for our students and the next generation of leaders to have the opportunity to hear terrific speakers like Stacey, who are providing immense leadership to our global finance and our financial markets. So we're delighted to have Stacey here. And it's just been amazing how you started your career on the trading floor at the New York Stock Exchange, and here you are.
It was a long time ago. But yeah, I did. I didn't expect to start there. I was studying engineering and ended up with an internship on the floor of the exchange and just fell in love with the markets, and it's not something I had ever thought much about, and it's contagious. So here I am.
Great. So a number of issues came up earlier today. So I'm going to bring some of those back and get your perspective on them. One has been, we had some conversation about private markets and the role of private markets and how they've become very large. And you have said, you made a statement about when companies stay private too long, then everyday investors can't participate in the greatest growth years of these companies. What is the optimum balance? Why have private markets become so big? And do you care about the public markets? Where are we going from here?
Yeah, I mean, we care very deeply about the balance between private and public markets, and private markets serve a great function. It allows companies to grow money, to raise money early on in their life cycle as they're developing their overall plan. And throughout history, we've just seen that balance shift a little bit as now there is a lot more access to private capital. So companies have the option to stay private longer because they can raise money. The reasons that companies choose to go public are usually some balance of four reasons. The first being raising money, so the access to capital. Second being liquidity, and so for early investors and employees. The third, the credibility of a public listing and the good housekeeping stamp of approval that the public markets give to a company. And the fourth is a currency, so they can engage in M&A and use their shares as a currency. Those four reasons still are generally the same four reasons, but traditionally it was access to capital and raising money that was the primary driver of why a company would go public, because there wasn't so much money available in the private market space. And because they have alternatives now, they're waiting usually, very often in many cases, for those other secondary reasons to be the primary driver. So, and it varies by company and by industry in many times. So for some of the software companies, having that credibility of a public listing is helpful as they're looking to acquire new customers, because they want to say, hey, we're a public company, our financials are publicly available, there's a lot more transparency. So as someone's signing a major multi-year deal, they know they're going to be around for a while. For many of the companies, especially out in California, some of the tech startups, they've been paying their employees with stock options and RSUs for so many years that they want that liquidity of the public market so they can go buy a house or plan for their futures and leverage the fact that they've been invested in this company. So that's a driver. And so you see those things are kind of the two primaries now. Why we care passionately about that is not just because we run public markets, because certainly that would be an opportunity for us to work through the private market space, but because of the impact it has. So there's a lot of conversation that happens around why. Why are companies staying private longer? And there's Certainly the regulatory structure and legislations around public companies are a factor, and certainly the access to private capital is also a factor. But what we get more focused on is what's the impact? And the impact is it's contributing to the bifurcation of wealth in this nation when companies are growing very rapidly in the private markets, and that growth is only available to a select few, and then coming to the public markets as more mature companies when their growth trajectory has settled off a little bit. That's number one. Number two, and I think number one is frankly the most important, but number two is it's reducing the discipline and governance in companies at a much larger scale. So when a company is small and they don't have that discipline and governance of the public markets, that's okay. But as they grow really large and those bad habits might grow with them, then I think we're starting to see the impact of that a little bit. And then third is the valuations of private companies are not the same level of accuracy that you get from a public market valuation, where you have real liquidity and many, many buyers and sellers coming together versus some smaller subset. And you have cases of perhaps just one transaction revaluing a company at a much higher price point before it comes public. And then that's information that influences investors. And the public markets end up with a skewed view of what the value of a company is. And you see that they'll correct it, right? So the public markets will correct that valuation pretty quickly. So I think those three things are really significant impacts. So we work on how do we, one, tackle the issue of the regulatory landscape, and are we putting too many restrictions on public companies? It's one thing, they're very well intended when we do it, but if that balance isn't right and there are alternatives, then companies will consider to stay private for much longer. And so issues that we get faced with a lot at the New York Stock Exchange are you should put, and I think we've talked about it here on this stage before, dual class voting structures. Hey, don't allow them in the public markets. My concern is investors won't have access to those opportunities at all. And I'd rather make sure investors have the opportunity to invest in the largest set of companies out there, but be armed with the information that they need to make intelligent decisions. And so those are the types of things that we spend a lot of time and energy on, and finding new ways for companies to come public.
So you mentioned credibility, discipline, and I'm thinking WeWork, the WeWork IPO. So in some ways, what happened there, was it a good thing for the markets in the long run? Because it seemed like some of the companies were really pushing on corporate governance and taking it to an extreme, in addition to the valuation issues. So does that kind of provide a reality check and institutional investors and other investors pushing back and saying enough is enough?
I don't want to talk about a specific company, but I will talk about the trends that we see. And like I outlined through the private markets, as companies are getting much larger, you're seeing new governance. And frankly, governance is an interesting point now when you talk about voting structures and outsized influence that founder CEOs may have. When they went public earlier in their life cycle, they still had control of the company because they owned most of the company. Once they've diluted their stakes through multiple private funding rounds, they actually now own less of the company, and so they're more incentivized to say, how can I find another way to maintain that control if I shift to the public markets? So you're starting to see more adoption of dual class voting structures where founders might want to take control. Investors have a say, and they should use their money to vote. That's what I love about this country, right? Is that market forces should survive, should prevail, and they weren't using that right. So investors were saying, okay, fine, there are companies coming out with voting structures we don't like, but we're still going to invest in them. What I think we are now is at a place where we did see investors speak up now and say, okay, this isn't a structure that we're going to support. We do want to see some changes made, and that's going to be we're at an important juncture for markets right now, because capitalism has been such an important engine to fund the growth of this nation, but it needs a little bit of a tune-up. We need to make sure that people are that it's working for everybody, because it's a story of shared success, and investors can change that by saying this is how it works for everybody. And so I'm optimistic that we're going to now see them take more of a say and really influence how companies are coming public. So the next few IPOs over the next 6 months, if we see them come to market with structures that investors want to reward and they perform well, I think that's a good outcome for the market.
Yeah. Great. Another issue that came up earlier this morning was about direct listings. So we've had Spotify, we've had Slack doing direct listings, and actually direct listings go as far back as Ben & Jerry in 1984, but didn't really take off after Ben & Jerry. Do you think they're going to take off now? Or?
So what Ben & Jerry did was a little bit different than what Spotify and Slack did, but I actually want to come back to that because it was really interesting tones there too. What direct listings have, this is like my favorite topic right now, so I'm sorry if I get a little too excited, and I talk fast when I get excited, so I'll apologize in advance. But Spotify, the CFO of Spotify, Barry McCarthy, came to the New York Stock Exchange in 2016 and said, I have an idea, don't tell anybody about it, but I'm thinking about coming, we want to go public, but we don't want to do the traditional way. We don't need money. We don't need to raise money, so why should I do an IPO? So what a direct listing really does is decouples the capital raising with the going public nature of the business, right? So you can become a public company and you don't have to raise money at the same time. And that's an important distinction because you can raise money. You can raise money either privately right in advance of listing, or you can raise money in the public markets after you list. You have access to capital, both equity and debt, once you become a public company. So you're just decoupling that. And it achieves a few, it was kind of driven by a few different reasons. One, just not needing the money, but two, there's a frustration that much of them, the first day pop, if an IPO is up 80%, that's a successful IPO, that's great. And frankly, what many companies are starting to say is, why is that great? So if I sold shares to investors and it goes up 80% the next day, I'm supposed to feel good about that that's a successful IPO? So they're frustrated with that money that's left on the table. And in fairness to the investment banks who are allocating those shares, if you think about how the market has evolved, traditionally, they were smaller companies that were a little bit riskier because they were less established. And so investors were being asked to take a stake in this company and hang on to it for a little while and give it some time to grow. You'll get a pretty quick return on that. When you have a company the size of the companies that are coming out to market, household names like Uber and others, do investors really need that first day pop for taking that risk? So there's some frustration with that. Because of that, the venture capitalists are selling less shares into their public offerings, which makes it a little bit harder for the banks to even price that IPO now because there's less coming to market, so there's a little more volatility, it is more likely to move. So the dynamics have shifted, and the response is, hey, let's go with a direct listing. And so we've only had 2 to date, but we've learned some interesting things from them already. Yeah. I mean, Spotify was a household brand, and so that seemed like a prerequisite for a direct listing. You have to have a brand name that is well known because investors will then be comfortable with you as a company. We learned with Slack that you don't have to have a household brand. Slack is well known in the technology community, but not well known other than by its users or outside of that community. It's certainly not a household brand name like Spotify. So you didn't really need to have that. And so there are a couple things that are different about a direct listing from an IPO. You don't do capital raising. You can provide information to everyone. So that was really important to Spotify, was to democratize the public listing process. So all people, retail investors, institutional investors, could watch their investor day that was broadcast on their website to anyone that wanted to see it, and they all had the same information because they didn't like the idea of only a few people on a roadshow having special investors, friends of the banks or friends of their underwriters that might have more information than any other investor. So they wanted that to be democratized. You can still do a roadshow. You can still go out and meet with those companies and tell your story. So that's what they did, and both Spotify and Slack did a roadshow. They expected there to be more volatility in a direct listing because you don't have this base that you can rely upon, where you know these shares were allocated. And what we saw was there was far less volatility in both of those offerings. Even more interesting, there was so much activity in those offerings. So the opening trades of those stocks, when Spotify opened, it was the 4th largest opening print of all time. When Slack opened, it was the 3rd largest opening print of all time. It's a $19 billion market cap company when it listed, and it traded $1.8 billion on that day. So that's roughly 10% of its overall value was trading just in that opening print. I'm sorry, it was $1.8 billion in the opening trade. So that's real price discovery when you come and you have buyers and sellers coming together like that. And everybody was on an even playing field. So No institutions were locked up. No employees or insiders were locked up. You got to the point where you typically don't get for 6 months when everybody can really trade freely. You got there day one. So it was really interesting to see that, and that's part of why I think there was much less volatility.
Changing subjects a little bit.
Told you it was my favorite subject, I'm sorry.
Proxy advisors.
Not my favorite subject, but one I spent some time on.
And ISS has recently sued the SEC.
Join the club.
Yeah, not your favorite subject, but an important subject from exchanges' point of view.
It is.
Really more from the issuer's point of view.
Yeah, there's much needed reform to be introduced to the proxy process. And under SEC, under Chairman Clayton's leadership, the SEC has made great strides on proxy reform, and in fact, they're taking action today to further some of that discussion. And they had a meeting this morning. But one aspect that we very often hear from our corporate issuers on is their challenges that they have with interacting with proxy advisory firms who serve a valuable purpose to the market. I mean, they're providing investors with insight and research and recommendations on how to vote. But some of the challenges are is the companies don't have the opportunity to correct information that might be inaccurate, to provide the counterpoint as to why shareholders might not have the full story if they just read the proxy report. And there have been a lot of examples where the proxy firm may make a recommendation and a company may challenge the recommendation and want to provide more insight, and instead they're offered consulting services from the proxy advisory firm, which seems somewhat conflicted. So there isn't regulation over that function, and considering the outsized influence they have on our markets, we do think it's appropriate for there to be new guidance around how those firms operate.
So I get it, what you're hearing from issuers on proxy advisors. What do you hear from institutional investors?
I think institutions want to be well informed, right? So our issue is not that proxy advisors should not perform a service. I absolutely think they should exist. Their information should be accurate, and they should have some standard that they have to live up to. I'll give you one anecdote. We had a CEO say to us, because we struggle with our interactions on trying to correct some of the inaccurate information in a proxy report, we picked the most objective thing they had wrong in their report, and we called the firm and we said, you have our number of shares outstanding wrong. And that's just a fact, right? And they said, well, thanks for pointing it out. We're not going to change the report. He's like, it's just a fact, right? So if there's nobody that's looking and providing a level of oversight there, they're not really, they're not going to be held accountable for making sure their work is appropriate. So the institutions want accurate information. We're not looking to take away the service that they provide. We just want to make sure it's overseen appropriately.
Again, to a slightly different topic, there's a lot of conversation about ESG. And I'm curious to find out, what are you doing as an exchange in terms of impacting ESG, and how are you working with your issuers?
So there is a lot of conversation around ESG on every front. So when we sit in the exchange space, and you might hear different, and from our seat, you might hear different perspectives on different issues from issuers or institutions, or but ESG is certainly a topic that's relevant to everyone that we speak with. And it's something that we also are very focused on as a company ourselves. And so as a company, we focus on, one, promoting diversity throughout the organization. On the ICE side of the house, we do a lot around sustainability and operating exchanges that provide renewable energy sources, and we operate carbon neutrality markets and all of those things. We do a lot within ICE as a company. As a listing exchange, we spend a lot of time educating our issuers on topics that are being discussed. What are the things that institutions are looking at? What are the things that are how should they be thinking about their peer groups? How should they be thinking about reporting on issues? So we hold a number of webinars, we hold a number of roundtables, and arming issuers with the information, because it's not really new. And in fact, I never went back to Ben & Jerry's, but this is a good tie-in. What Ben & Jerry's really did that was very interesting is they were ahead of the game on ESG. So they thought it was very important to their company that they thought about all stakeholders and not just shareholders, and they were very, very focused on that. So when they wanted to raise capital, they did it just from Vermont residents in an unusual structure. And they raised money from Vermont. Even when they sold to Unilever, part of that agreement was Unilever was going to spend a certain amount of money on sustainability. Unilever was they had a whole laundry list of things around ESG that was part of that deal because it's so core to their culture. And you're now seeing a lot of other CEOs thinking about that. You're seeing a workforce that's demanding leaders to be thinking about that. And so issuers are trying to wrap their head around these issues as they're evolving and very rapidly evolving. And then one of the other things that we do for the institutions is through our ICE Data Services business, focusing on indexes and ETF products that can provide investors with well-packaged instruments that can help inform their ESG trading.
Yeah. So one of the challenges with the S part of the ESG that came out this morning that Waqas Samad from FTSE Russell was talking about a little bit is different index providers or different whatever agencies out there, they have different ways of measuring ESG. And it reminded me of where corporate governance was about 15 years ago. Everybody had their list of, these are the criteria, and issuers were struggling with, what do I follow? What really matters? And actually, academia provided a lot of research on that and gave a sense of what is really important in governance, what matters.
Yes.
How are issuers dealing with that?
They are struggling with that right now because there are so many different standards, so many different surveys that they receive, and they're trying to figure out, do I answer all of these? They're not all phrased the same way. They're not all looking for the same. So it's a lot of work actually for them to go through that process as they're trying to make sense of the various interpretations, which I do think is, we talk a lot about the balance between public and private. We want to make sure that we're not putting so many restrictions and so much complexity on public companies that they'll just say, you know what, it's not worth it. Let me wait until I have a whole team that can deal with those things. I'll just stay private. So that is why we spend a lot of time going through the educational process around ESG. How should they be thinking about it? And providing peer feedback. So because we are a data provider, we're collecting a lot of that data. We can go to our issuers and say, here's what we see, here's, X percentage of your peers also didn't disclose that information. So we can start to inform the industry and also those that are collecting the information, hey, maybe you should think about these a little bit differently because people aren't reporting it for a good reason.
Right. So what are additional value-added services that you're providing to your issuer these days? This is a good example of what you're doing on the
certainly.
ESG
I mean,
front.
when we look at the community of 2,300 public companies that we have on the corporate listing side, and that's certainly a network that's valuable for them to learn from each other. So we provide and host a number of events at the exchange that can educate them on issues around ESG. We host IR summits. We bring their general counsels together. So a number of different things on that front. With some of the regulations that we've seen through MiFID, we've seen banks evolve how they provide corporate institutional access. And so we launched an investor access program bringing in companies from certain sectors for a particular sector all day to meet with one-on-one meetings with institutions in that sector. And then they both select, who they'd like to meet. It doesn't replace the services that banks are providing, but it provides them with access to institutions and investors that they might want to have relationships with. So just continuing to build on the services that we provide them as being, part of their overall listing is something that we continue to think about.
Mm-hmm. So before I open it up for questions from the audience, I have to ask you, what has been the best part of being the president of the New York Stock Exchange Group?
I have some friends in the audience who might make fun of me now. So I will say, for me, what has been the best part over the past year and a half since I took this role is I was so markets focused, and I always came from the trading side of things. And I mean, as you can hear today, I spoke mostly about corporate listings and corporate issuers. That's the perspective I've had over the past year and a half, partially because I was less familiar with that part of the business, and it also sort of demands immediate attention. That's really been interesting to meet all of the different companies that have come to the public markets to raise money, and they are changing the way we live, work, and play every single day. That's fascinating, and they're in all different geographies and all different sectors, and that's the mission of the New York Stock Exchange, is to help companies raise money so they can go out and change the world, and provide an opportunity for investors to share in that success, which is the piece that I think we need to make sure we don't lose sight of. But that's been fun to go out and meet all those interesting people.
Stacey, as you can see, we have people lined up. I would really appreciate that we give a chance to people who haven't asked a question yet. So I'm going to call on people who haven't asked questions, and if there are others who are interested and you haven't asked a question yet, please feel free to come up. So let's start here.
Hi, my name is Kristen Seraphin. Thank you so much for being here. I appreciate hearing from a woman in finance. I had a question for you about floor brokers. And I know with NYSE's acquisition of NYSE Chicago, with the institutional brokers as well, can you talk a little bit about, I know you got your start on the floor, but what you see as the role of floor brokers going forward?
So we believe strongly that the combination of people and technology is so much more powerful than either one of them on its own. And so there's still a demand for us to allow for human judgment to be implemented into the trading process. About 20% of our provided volume comes from the trading floor. And if you look at the closing auction, that is the largest liquidity event in the world. And a third of it comes from the floor brokers on the trading floor. So there's still a lot of human input. Our stocks are overseen. Every company that's listed on the New York Stock Exchange has a floor broker that's known as a designated market maker that's assigned to trading that stock. And our stocks trade with less volatility because they have higher standards and higher obligations than any other market participant. So we do believe that there is a future for that model because we get better results for our issuers, especially during periods of volatility.
Okay, thank you.
Can you talk about quickly about your view about the industry demand of the SIP feed, the security information processor, evolutions?
Yeah, market data in the industry has evolved pretty dramatically over several years, and so much of that is also because of Reg NMS. So as NMS was adopted and markets became more fragmented, as competition was promoted for the best price, industry participants had to stitch the market back together to figure out where that best price was. You started to see a bifurcation of just wanting to know what the industry standard best price was and where is it on each individual venue. So you started to see the proprietary market data feeds and the SIP feeds. There's been a lot of investment into the SIP feeds over recent years, and so I think there's a misperception of their performance. They are highly performant systems, but they have a geographic difference and also use difference for some of the market participants. So they're never going to be as fast as somebody who's taking information directly from an exchange. The New York Stock Exchange recently suggested a proposal that would redefine the way the SIP data is categorized. So different types of users could subscribe to just the information that they want at a lower price point, and especially if they're not sensitive to latency, and we could also provide more granular information to other users. So it's a work in progress. There's a lot of industry debate going on right now about how we can continue to improve that and make sure it's evolved for today's market structure.
Pat?
Hi, my name is Pat Healy. I'm sorry for my raspy voice. I run a company called Issuer Network, and I help companies list on the New York Stock Exchange and NASDAQ. Stacey, I'm sure you've seen my comment letters in which I describe the access fee pilot as the single dumbest proposal ever suggested by the SEC in its almost 100-year history. And I salute you guys for suing them over that. What I'd like you to do is look into your crystal ball and tell me how this is going to be resolved. Well,
so the access fee pilot, which became the transaction fee pilot, was adopted by the SEC, and we did challenge it legally. I will say we tried pretty much every other way we could to prevent that from occurring. We had suggested an alternative proposal that we thought made a lot more sense, because it does make sense to rethink access fees. So we were supportive of lowering the access fee across the board, but not in different buckets. And the reason why that was an important distinction for us is it's an important distinction for our listed companies. They don't like the challenges of having their competitive landscape be defined by a market structure experiment. And frankly, we don't believe that the SEC can run the pilot without proof and establishment of a problem in the market, so which is why we sued. I don't know that my crystal ball batteries are charged right now, so I might need to revise those, but I will say we went through the oral argument process recently, and we're waiting to see what comes from that.
Again, those of you who haven't asked a question yet, I'd ask you to ask the questions. If you've already asked, ma'am, I'd very respectfully, if we can get especially our Georgetown faculty and students to ask first. Professor Angel.
Thank you for being here today. If you could change any part of our regulatory system, what changes would you make?
Wow, that's a good question. I do think the NMS plans are a real struggle in the regulatory system. I think there's a good use case for them. And I think that when we do need exchanges and SROs to come together, that's very quickly to solve things like limit up, limit down, or some of the market reactions. I think that's a great use case for them. I think in other areas, the NMS plans lead to a lot of conflict within the industry, and the SROs end up having the obligations of making sure they're implemented correctly, which is why we feel strongly about having the say in how they're designed. But that leads the industry to being left out, having the perception that they're left out of it. While they can comment through the process, they don't have a vote. If we took it out of the NMS plan structure and we're not the ones left carrying that accountability solely, I think that would be a better outcome.
We have a student here who wants to ask a question.
Thank you, but I'm not actually a student. I'm with NASDAQ. My name's Emma Anneman. Thank you.
It looked like a typical Georgetown student.
So you want me to go first?
I'll be quick. So I just wanted to go back to the topic of ESG and was wondering your thoughts on the Business Roundtable's letter on the changing corporate purpose.
As I talk to many, many CEOs, I agree with the philosophy, what the Business Roundtable was saying, personally about being focused on stakeholders. But as I talk to many, many CEOs, many of them who say, that's how we've been running our business, that's been important to them, and that it's hard to actually have a profitable, successful, long-term business if you're not focused on a variety of stakeholders. So I think what was really significant about that was making it clear that that's how many leaders are thinking about running their businesses. And it's a little bit of saying, we hear you as well. But I think that when we talk about being focused on the social good and the purpose of all stakeholders, I think about that in the context of the private markets as well. CEOs, founders, venture capitalists, I want them to have that stakeholder view also and recognize the social good that they're providing when they bring their companies public sooner in their life cycle. One example, well, two examples. Coca-Cola, if you bought 100 shares of Coca-Cola when it went public, it'd be worth $55 million today. It's a good growth opportunity for you. Now, yes, that was 100 years ago. 15 years ago, Salesforce, when they IPO'd, it's up 3,300% from its IPO. That compares to 163% return in the S&P 500. That happened earlier in its life cycle, that they came out public and people had access to that. So we just want to see companies sharing those opportunities with the general public earlier.
Yeah. Please go ahead.
Okay, thank you. My name is Li Yang. Congratulations about your leadership at the NYSE.
Thank you.
I do have a lot of experience from the exchanges trading and things like that, and it's stock brokers or their takeover or mergers. Mm-hmm. For instance, like Mellon Bank or New York Bank or Financial Free Exchange or Quick and Ready. Mm-hmm. They kind of change and take over, and you really have no that kind of vision that was such a change, and then suddenly sounds like I'm here standing like a dead man crusading. And I just was doing this by several decades already, and I just wonder exactly how NYSE can work with government agencies, really resolve the problem. Seems like police or attorneys, whether local to federal or officials, they are not doing anything. So it's just day after day, month after month, year after year, decade after decades. I just want to admit that our society is dependent on those leadership, but they are changing their leadership around, so we have nowhere to go. So I just want to ask the leadership now, I'm very optimistic. You can do something.
Thank you. There's been a lot of consolidation in a number of members across the industry, and I think not just trading firms or broker-dealers, but also companies as scale becomes such an important part to effectively run a business. And we just want to make sure that the regulations balance investor protections with the flexibility to run a business. And the SEC has certainly focused on that and making a lot of changes that are very productive toward that effort. So I'm optimistic that we're going to continue to see some improvement on that front.
Okay, I depend on
And
you. Thank you.
two last questions from Dave and Rahul.
Sure. So we know Stacey is an industry leader, but some of us that have worked with her know that she's a great team leader. So speaking to the students of Georgetown, what would you say is a good approach to trying to be a leader in the industry?
I think when you're building a team, the most important thing to do is, one, try to find people who you think are better than you to be on your team. Some people take the reverse approach and think they want to look like the best person on the team, and my advice to you would be hire better team members. You'll all work better and be better when you have a stronger team. So always hire the person that you think can take your job. It frankly also opens you up to go do other jobs, so don't be too scared of that. And then two, support each other. I mean, if you're not focused on a shared common goal, you're not going to be as successful as you can be as a team. So I like to surround myself with people who have a positive outlook and make us better, each of us better versions of ourselves.
Rahul?
Thanks. Hi, Stacey. Question for you to build on what you talked about with direct listings as an alternative to IPOs, your favorite subject.
Recently.
Would love to get your thoughts on the SPAC product, and if you see that as a sort of a third way for companies to go public. And there's a lot of them that have come to market recently, and that I see sort of a growing number of SPACs coming into the market. And I've heard critics of it say that it is sort of a loophole for companies that aren't really viable to go public or big enough to go public. It's a way for them to go public. Would love to get your thoughts on that.
Yeah, I mean, I think what you're seeing both with SPACs and direct listings are people asking for different outcome, right? They want to have different options because they think the classic product isn't working for everybody. And that's sort of that first day pop on the IPO is making people say, well, why would I want to do that? And so with a SPAC, you raise the money and you become a publicly listed corporation, special purpose acquisition corporation, with the intent to go out and acquire a company who actually has operations. You're given a timeline, so you only have 2 years usually to go find that acquisition. And your investors have the ability to get their money back if they don't like the acquisition. We are seeing more companies take that route, and I think you're seeing that, one, because the markets have been strong. There have been strong leaders who have said, well, hey, I want to go launch this, but I don't want to start a whole new company and then go public. Literally last Monday, we had Sir Richard Branson on the floor of the New York Stock Exchange wearing a spacesuit because he took the first ever space tourism company public, Virgin Galactic, listed on Monday, and they listed through the SPAC structure. So that was their way to the public markets. Lots of fireworks. That's a fun part of the job too. But so I think we need to listen to what investors are telling us, and they're saying, hey, the IPO process isn't necessarily for everyone, and if your goals have shifted, should the outcomes, should your approach to the public market shift too? So I think you'll see more in the future from both SPACs and direct listings, unless we start to evolve the IPO process itself.
Please join me in thanking Stacey for great insight.